Welcome, investors. Today, we'll delve into the top 10 investing strategies for financial success. From tried and true methods like dollar cost averaging to advanced techniques like options trading, we'll explore a diverse range of approaches to help you achieve your financial goals. Whether you're a seasoned investor seeking to refine your strategy or a beginner eager to learn, join me as we unlock the secrets to building wealth and securing your financial future. Let's dive in and discover the strategies that will set you on the path to investment success. Today, we will talk about top 10 investing strategies for financial success. So before we get started, make sure to hit that like button, also subscribe to my channel. 1. Have a financial plan. The first step toward becoming a successful investor should be starting with a financial plan, one that includes goals and milestones. These goals and milestones would include setting targets for having specific amounts saved by specific dates. The goals in question might include, for example, having enough savings to facilitate buying a home, funding your children's education, building an emergency fund, having enough to fund an entrepreneurial venture, or having enough to fund a comfortable retirement. Moreover, while most people think in terms of saving for retirement, an even more desirable goal would be to achieve financial independence at as early an age as possible. A movement devoted to this goal is financial independence. Retire early. While it is possible to create a solid financial plan on your own, if you are new to the process, you might consider enlisting professional help from someone such as a financial advisor or financial planner, preferably one who is a certified financial planner. Finally, do not delay. Seek to have a plan in place as early as possible in your lifetime, and keep it a living document, updated regularly and in light of changed circumstances and goals. 2. Make saving a priority. Before you can become an investor, you must have money to invest. For most people, that will require setting aside a portion of each paycheck for savings. If your employer offers a savings plan, such as a 401k, this can be an attractive way to make saving automatic, especially if your employer will match all or part of your own contributions. In setting up your financial plan, you also might consider other alternatives for making saving automatic, in addition to utilizing employer-sponsored plans. Building wealth typically has aggressive saving at its core, followed by astute investing, aimed at making those savings grow. Also, a key to saving aggressively is living frugally and spending with caution. In this vein, a wise adjunct to your financial plan would be creating a budget, tracking your spending closely, and regularly reviewing whether your outlays are making sense and delivering sufficient value. Various budgeting apps and budgeting software packages are available, or you can choose to create your own spreadsheets. 3. Understand the power of compounding. Saving and investing on a regular, systematic basis, and starting this discipline as early as possible in life will allow you to take full advantage of the power of compounding to increase your wealth. The current protracted period of historically low interest rates has diminished the power of compounding to some extent, but it also has made starting early to build savings and wealth more imperative, since it will take interest-bearing and dividend-paying investments longer to double in value than before, all else equal. 4. Understand risk. Investment risk has many aspects, such as default risk on a bond, the risk that the issuer may not meet its obligations to pay interest or repay principal, and volatility in stocks, which can produce sharp, sudden increases or decreases in value. Additionally, there is, in general, a trade-off between risk and return, or between risk and reward. That is, the route to achieving higher returns on your investments often involves assuming more risk, including the risk of losing all or part of your investment. 5. Understand diversification and asset allocation. Diversification and asset allocation are two closely related concepts that play important roles both in managing investment risk and in optimizing investment returns. Broadly speaking, diversification involves spreading your investment portfolio among a variety of investments in hopes that subpar returns or losses in some may be offset by above-average returns or gains in others. Likewise, asset allocation has similar goals, but with the focus being on distributing your portfolio across major categories of investments such as stocks, bonds, and cash. 6. Keep costs low. You cannot control the future returns on your investments, but you can control the costs. Moreover, costs, aid, transaction costs, investment management fees, account fees, etc., can be a significant drag on investment performance. Similarly, taking mutual funds as just one example, high cost is no guarantee of better performance. 7. Understand classic investment strategies. Among the investment strategies that the beginning investor should understand fully are active versus passive investing, value versus growth investing, and income-oriented versus gains-oriented investing. While savvy investment managers can beat the market, very few do it consistently over the long term. This leads some investment pundits to recommend low-cost passive investing strategies, mainly those utilizing index funds that seek to track the market. 8. Be disciplined. If you are investing for the long term, according to a well-thought and well-constructed financial plan, stay disciplined. Try not to get excited or rattled by temporary market fluctuations and panic-inducing media coverage of the markets that might border on the sensationalistic. Also, always take the pronouncements of market pundits with a grain of salt unless they have lengthy, independently verified track records of predictive accuracy. Few do. 9. Think like an owner or lender. Stocks are shares of ownership in a business enterprise. Bonds represent loans extended by the investor to the issuer. If you intend to be an intelligent long-term investor rather than a short-term speculator, think like a prospective business owner before you buy a stock, or like a prospective lender before you buy a bond. Do you want to be a part owner of that business, or a creditor of that issuer? 10. If you don't understand it, don't invest in it. Given the proliferation of complex and novel investment products, as well as of companies with complex and novel business models, beginning investors today are faced with a vast array of investment choice that they may not fully understand. A simple and wise rule of thumb is never to make an investment that you do not fully understand, particularly when it comes to its risks. A corollary is to be very careful about avoiding investing fads, many of which may not stand the test of time. If you like this video and would like to see more like it, please give it a thumbs up. Leave a comment and click the subscribe button.